Hi there, my name is Rick Grantham, and I'm an executive at Deal Leaders International. I'm just going to spend a bit of time talking today about the process that we like to follow, the process we do follow when it comes to selling businesses, finding investors for businesses, and just trying to partly give a sense as to kind of what we do and how we do it, just so you kind of get to know us a little bit, but also to provide some insights for those of you who just trying to understand it better, trying to work out where do I go over the next 2, 3, 4, 5 years if I want to build an asset of value, if I want to build a business that I can sell in the future. What do I need to do? What do I need to think about? I'm going to be a little bit contrarian. We don't believe that the traditional methods work very well, and hopefully that'll come through quite clearly. And given that probably 70% of the clients that we take on have tried to sell their businesses before and have been unsuccessful. And so by the time they get to us, they realize, yes, there's something unique here. There's something we don't know, something we don't understand. And what we've tried to do is bring together, between Andrew Ballman, myself, Andrew being my business partner, and we try to bring together all of our experience, as well as experience from around the world where we've worked, where we've got involved, where we've learned different processes, and brought those together into something that we believe really works. I'm going to share my screen and hopefully, share some useful insights with you that you can either use yourself or come and speak to us, and we can share more thoughts with you. So as I mentioned, we are a bit contrarian. There's certain things we don't agree with the kind of traditional approaches. And probably two most important things. I think the first one is that selling a business is nothing like selling a property. And unfortunately, so many people come into this, into the idea of selling, thinking, well, that's how it's got to work. I've sold properties before. I got a valuation. I got a sense of how much the value of the property was. I then went through some kind of marketing activity, got some people interested. Of course, I put a price on it. That was very important, because otherwise, how would people know, whether they could afford it? Put a price on it, took it to market. Hopefully within a few months, I've got a good offer. That offer is a binding offer. So I don't have too much risk in it. Sure, it might fall over, but not too much risk. It's a binding offer. And give me 3-4 months now, my deal is done and the money's in the bank and I hand over the property. It's quite simple. One thing I can assure you is that selling a business is nothing like that. In fact, even I think the people in the traditional M&A world, mergers and acquisition world, try to apply a kind of similar process. It's about the valuation. The transaction is the process is very valuation driven. Do a very complicated financial valuation on a business, and then go and find someone willing to pay for that, and find a structure that will work given the people that you've got at the table to help them to come up with that deal. Unfortunately, it doesn't work that way. And invariably, not only is value destroyed, but just often deals just don't happen. It's very hard to find the right acquirer, particularly in the kind of mid-market to smaller corporate space. It's very hard to make that kind of process work. So hopefully today's going to help you with that. I'll try not to take too long. Should be done in 30 minutes or so. And I can give you some real insights into an alternative approach, something which works differently, and at the same time tell you a little bit about who we are. Get to give you a sense of the clients we take on, the deals that we've done, which I think should be quite useful. I'm just going to start by just trying to get a bit of alignment with what you might be going through and what's important when it comes to an exit strategy. We all build businesses, or I assume a lot of entrepreneurs in the audience, we build businesses with the idea of one day selling them. Ideally, what you're doing is you're building effectively 3 streams of income. You're going to earn some form of a salary out of your business. You're going to earn some kind of dividends out of that business. Ultimately, you want to get some equity value out of that business. And it's particularly that third one, and to some extent the first and second as well, that we want to give you some insight into how you can use an equity transaction to make a difference. So where are we in the, initially one's thinking about value, and what are the levers of value? How do I make my business into a valuable business? And I'll just give you a little hint up front when it comes to selling a business for significant value, or for getting value for a business. The last thing you do is put a price on it. So yes, you need to understand the value in your business, but the last thing you want to do is actually go and put a price on it. You kind of know what you'll never get the moment you've done that. So there are all sorts of tactics to deal with this process without actually putting a number and putting a price on a business. But value is important. It's that value that ultimately we say, okay, that's enough. Now I need to go through a process of selling. to be honest, that value is often a slightly emotional number and more linked to people's wealth than it's linked to the actual true value, because it's the value that you believe you need, and the value that you believe makes all that sweat and hard work worthwhile, is really what that numbers are all about. And the other important thing is about your timeline. Generally, we are finding that from the date that someone starts with us, and of course, this start means preparation and things I'll go into shortly, but from that moment that you start the process to actually having your money in the bank is a good 18 months. Listen, every now and then we're lucky and we strike lucky and we get it done in 12 or maybe a bit less, but generally one's looking at more like 18 months and sometimes longer than that. And then often there's a process of staying and working with the new owners. Maybe it's a short 6-month handover. Often it's more like a 2 to 3 year handover in order to maximize value. So you've got to plan for this. Rather plan 2-3 years ahead and work on when's the right time to get started, rather than waiting till you really want out. And now you suddenly, you're stuck with a long timeline to get out, and chasing a timeline will generally destroy value in your pocket. So being patient is critical, having time and planning well ahead, and very, very important in the sale of a business. Personal energy is an interesting one. I think so many of our clients are just a bit cut full. It's been a long journey. It's not like they're old and wanting to retire. They just want something new. And so often, and I think it's a reality in our kind of South African environment, we've got a lot of businesses, very successful businesses, but being held by owners who kind of lost the real energy to grow it significantly, to take risk. And that's when one risks this sort of tapering of businesses, where in fact they're not growing, which means they're getting smaller and they're facing more risk if they're not growing significantly. You want to keep the growth going. If you're done with investing further cash into your business, well, maybe it's time to find someone else who is willing to. And that's probably the biggest secret towards finding the right acquirer, is in whose hands is this going to be more valuable? In who looks at my business and says, wow, I want to grow this thing, rather than me, who might sit there saying, sure, I'm tired of taking this risk. I want to get some more money in my pocket. Which of course brings me to the fourth sort of key issue around exit strategy. And that is really the risk that you're taking by holding on to your business maybe a little bit longer than you should. And of course, where's your wealth? I think far too often we speak to business owners and they've got 80-90% of their wealth actually sits in their business. So when they talk about diversifying their portfolio of wealth, or their portfolio with a wealth manager, they're looking at a small piece of their wealth that they're trying to diversify internationally and locally and across different sectors in the equity markets and bonds and interest-bearing debt and so on. But they're not actually looking at the wealth that sits in their business and what are they doing about that wealth, and is that potentially at more risk than other investments that they've got. So one needs to look at your wealth across everything, including your business. And just far too often we find that people are risking a huge amount of their wealth. And we, unfortunately, there are a lot of horror stories about people who kind of just left it too late, didn't take into account that risk. Things were looking too good, didn't really have a backup plan around their wealth. And then something goes wrong and something doesn't work out in the business. Some unforeseen activity from competitors, change in regulation, something comes along, and suddenly the business isn't worth what it was before. So yes, risk is vital, very important in our view, to have a good wealth manager, to speak to people like ourselves or other consultants who can help you talk about the risk in your business, and make sure you're not taking too much risk with your business, and that you've truly diversified your wealth. Just another way to look at this, and I think something that we often go through in that first discussion we have with potential clients, is what are you really looking for in trying to find someone to invest in your business? Are you trying to get wealth out of your business? By wealth, what I mean is, I've got a business worth 100 million. I don't need 100 million, but geez, I wouldn't mind taking 30 out, or 40 or 50, so that I can at least start looking after my legacy, my family, those kind of things, and just extract some wealth from the business. I don't want to leave it, but I just want to share the risk with someone and look after my wealth and get some wealth out of the business rather than having it all in the business. The second point is growth. It's the reality is that we some people have fantastic performing businesses. They want to grow them, but they're just at that point where they don't want to grow it with their own cash. How do I find someone else who can bring value to this business, and bring investment to this business to help it grow? And then, of course, what a lot of people are looking for, often depending on age, on timing, various different issues, perhaps immigration, and they're looking for exit. And the big trick with exit is to give yourself enough time. Otherwise, it's extremely difficult. Just a few examples. My image is in the way here. But yeah, a number of examples where people say, I just want a strategic partner to help me grow this thing. Got an interesting example now with a foundry, been beating themselves up against, being beaten up by international competitors, and just want to bring an international partner into that business so they can grow it. Not truly looking to exit. A number of the shareholders would stay on, but really just trying to look for someone to help with that growth process. Just click that on. Another one, interesting one, the Stephen, a real example, was just done. Fantastic. The business has been really good to him. He had drawn lots of wealth out of it. He had built houses, built properties, owned a lot, and just wanted to get out. Sometimes that can come with a bit of a discount on the price, but if that's what you want, you've got to find the right party who's still willing to pay that and doesn't need your help to continue with that business afterwards. Not always possible, can be quite difficult, but you've got to look, and you've got to take that into account. If that's what you're trying to do, you've got to find the very best way to do that. And then lastly, Anton's a good example of a company needing just a combination of growth and exit. Some shareholders, I think often you find you've got multiple shareholders with different strategic visions for themselves, in fact, different personal visions for themselves. And in this case, two of the shareholders wanted to stay, one wanted out, but the ones who wanted to stay really needed a growth partner. They'd set off on a very ambitious group of projects, and they needed someone who could help take those projects to success. So yes, some did manage to exit for a fine sum, and the investor actually put a large sum of money and committed a large sum of money into the business as well, enabling that business to really perform into the future. So that's a kind of best of both worlds, that kind of growth with wealth and exit all at the same time. Definitely something to look for. Not always easy to find, but certainly something to look for. So I'm now just going to go through what we call our 6 principles in achieving the best deal. I suppose this is really what our kind of process in the business is all about. I'm just going to go through them one by one, hopefully not take too much time over each of them, but just talk to you about what we believe those critical issues are when you're trying to get the best deal possible. The first one seems a bit odd, but just don't be passive about it. We have quite a few potential clients come to us and say, I'm not looking to sell, but if someone offered me the right price, I'd be keen. Well, how on earth are they going to get to the right price if they don't know something about your business? And how are they going to learn about your business if you don't go front foot to them and say, this is my business, this is what it looks like? There are all too many examples of people who get approached by someone. It all sounds amazing. They get told that we value businesses using this principle. Yours is going to be worth a fortune. I can see it. And they get drawn into a process which they don't control. And pretty much the moment you shake hands and sign a bit of exclusivity, and they say, just need to do a due diligence in order to decide what the right value is of this business, the moment that starts, you're handing over control to the acquirer. And you can be there for 6 months, you can be there for a year, and almost never really know what they're willing to spend on the business until it's kind of too late. You also find that when an acquirer, unfortunately, a lot of acquirers behave badly, not all of them, but a lot of them behave badly, and when they know they're the only one at the table, they can't help just looking for the risks and forgetting about the opportunity. And as they look for those risks, the price is kind of lowering and lowering. And you just, you really don't win from that. You spend a lot of time, you get deal fatigue before there's even a deal on the table. And it's a very tough space to be in. So you can't be passive. You've got to be front foot. You've got to be making this deal happen. You've got to take it to the right people to get the right kind of deal done. I mean, this is a real example of a lady named Louise who had a great business, literally spent 2 years trying to sell it to one particular party. And 2 weeks beforehand, it's an international company, they made a strategic decision in the boardroom, no more deals in Africa and South Africa, we're out. And that was it. So 2 years of effort I think Louise remains gun shy and hasn't approached the market again. It really was that damaging to her and her business. Just the next key issue here, or next key principle, is this idea of choice. People often come to us saying, this is what I want. I want to sell 80%. I want it funded like this, and I want this much. I can, maybe do a business sale here and a company sale there. And this is what I want this whole transaction to look like. It kind of doesn't work like that. You really do need acquirers to bring their ideas to the table first. So in our world, we're not being passive, we're being proactive. But then we're going to multiple parties to make sure we get the right choice at the table and the right options at the table. To get choice, I can assure you, isn't about just going to 5 people instead of going to 1 person. To get choice, you generally have to go to about 100 to find the right ones who are willing to take it further. We'll often start with 100 potential acquirers we'll contact every single one. Maybe get 20 or 30 NDAs signed where we send an information memorandum to them. From that, probably 10 meetings, maybe 5, maybe 10, maybe 15. If it's 15, it's getting a bit hectic because that'll really wear you out. But you want to engage with clients, and I'll talk more about that later as to why. But ultimately, you want more than one offer. In the last 2 deals, we closed 2 at the beginning of March this year. Both of them, one was in the pellet sector, one was in the pharmaceutical sector. But sorry, not both of them. I'm actually not right. Then the pellet one, we got 6 offers in. When we've just working on now a debt collecting business, we also got 6 offers in. That gives you a huge opportunity for choice. To be honest, the pharmaceutical one, we got 1 offer. We're not sure the acquirer knew there was only 1 offer on the table, but we've got 1 offer. And because of that kind of threat of some kind of competition, them realizing that these guys were well prepared, they weren't passive about it, they were very proactive about it. We got a great offer right up front, and that was the deal. We closed it at that exact offer. But yes, that's a bit more rare. And generally what you want is you want those choices. You want multiple offers at the table. You learn through those offers. You understand what really makes up an offer. Because unfortunately, I think a lot of sellers don't really understand what we mean by choice until they have it. And in fact, this entire process, it's not about a price. And that's what you really have to remember. It's about a number of things. It's about the price, the terms, how it's being funded, how quickly it's going to happen. Funny enough, in this, the debt collecting business I mentioned, the simplicity of the deal was of much more value to the sellers than the price. But by simplicity, I mean, basically it was a single acquirer. It wasn't an acquirer bringing together other parties. It was a very, very clean due diligence process that the acquirer was going to do on their own. They weren't bringing in a kind of big 5 accounting firm. And all of those things were just simplifying. And the funding was dead simple. There was no debt in it. It was straight up sort of private equity type funding, straight from a fund. And no question of extra structure thrown into that. And quite a fair deal in terms of upfront and a portion being delayed. So often one just doesn't expect that level of choice to come out of it. And you don't expect to find something is really going to suit you. And if you don't go looking for choice and making sure you get proper choice at the table, you'll find you're in a bit of a corner and you've got very little negotiating power. Choice is absolutely vital. And I mean, this does actually happen quite frequently, where you actually get sellers who think they know what they want, but then suddenly they find someone who they can really work with. They say, hold on, I don't want out anymore. This works for me. I'm going to rather let me do a 50, 60, 70% deal and engage with these people and work alongside them for a bit longer, and therefore maximize my exit by also having that 40 or 50% to sell later. And this is very, very important about how one approaches the market. You don't want to approach the market with a very closed deal saying, I want to sell 80% or I want to sell 100%. You rather want to work out, how broad can I go? Let me go from 60 to 100. Let me go from 40 to 100. Now I know I'm going to get proper interest coming to the table. And from there, I can start working out the choice and start negotiating once I've got an offer, rather than trying to negotiate before you've got an offer. Probably, after that issue of not putting a price in a business, biggest trick number 2 is don't try to negotiate before you've got an offer. You need that offer. You need something in writing from an acquirer before you start negotiating your way forward. It simply doesn't work to try to negotiate just verbally rather than negotiating with something in writing on paper. Let's go into the next key principle here. And I guess many people would say this is obvious, but people just get it wrong so often. It's just being well prepared. And the key thing here is about not just having some glossy document that you can share with people. I mean, to be honest, I think that websites are terrible sellers of businesses because they don't really tell you a lot about what's going on with the business. And as I'm sure you all know, your financials are also pretty bad for selling your business because they are designed to pay less tax. They're not designed really to sell your business at all. I know there might be some other slight variations on that, but generally we try to make sure that we present the business in the best possible light in that information memorandum that we take to the market. In order to get the buyers to come in, the best possible buyers to come through the door. Because we know once we've got them there, we can talk to them about it, we can convince them of other things. But if we can't get them through the door, you're really going to struggle. And this is a key and sort of a key add-on to that is the size of a business. The trick to selling a business is to attract the best possible acquirers to the table. And unfortunately, size does count. So, a business doing 5 million EBITDA, it's going to be tough to get the right people to the table. And generally, you need to be in the 15 to 20 plus. And from by plus, I mean, we'll go up to 100 and more on the bottom line, so pre-tax, that you've got to be achieving in order to get the right type of acquirers to the table. Otherwise, unfortunately, you're not necessarily dealing with the sufficient quality in terms of acquirers. Acquirers are really willing to pay for good quality businesses that they can take forward. But the key elements of the preparation that we do and the preparation that you need to do. One is understanding the business and presenting the business in a way that is clean, succinct, not too much information. And something else which in the traditional play goes wrong is that people tend to present basically a prospectus of the business. They want to put together all the information possible about this business, all the financials, evaluation, all of the detail, and they want to present everything up front. We're quite cautious about that because part of our process, which I'll talk a little bit more about later as well, is when and how we share what information with acquirers. You can't give it all to them up front because initially they will tend to ignore the real opportunity and go straight to the numbers. We try to not share too much numbers. You've got to share the numbers. People have to get an idea as to what this is worth. But it's really about the other stuff that you've got to use to get people excited about a business. The numbers can come in later, and I'll go into that process shortly. But presenting it right, financial analysis, absolutely critical. We, of course, do some valuation work up front, but to be honest, the valuation is really just about getting alignment, understanding how the market is likely to see this business from a value perspective. The true thing is to evaluate the business. Where are the opportunities? What are the value drivers? What are the growth drivers in this business? What's going to help us find the right buyers based on the financial performance? But yes, financial analysis important. We will always build a very powerful financial model for every business we take to market so that we can really, and that partly helps you understand the business, but also helps you present the business, particularly when it comes to forecasting, balance sheet forecasting, etc. So that financial model is critical. And yes, accurate presentation of the business is vital. There may well be adjustments to be made. Generally, the market is comfortable with adjustments, and one's just got to make sure there's enough evidence to prove why something was adjusted, rather than just taking a thumbs up and say, well, I only show 5 million on my bottom line, that's actually 15. Just believe me, that's not going to cut it. So one does need really good evidence of that. And then, of course, the third part of preparation is who are we going to approach? Now, I talked earlier about valuation-driven sales process. In effect, what we promote is the idea of an acquirer-driven sales process. In whose hands is this business the most valuable? Because they're most likely to give us the best deal. And that's around this prospect research. As I mentioned earlier, we will typically approach, I suppose it's somewhere from 70 to 150 potential acquirers in order to find the right acquirer who's going to offer the right deal. So it's very intense. It's probably where most of our kind of IP sits, is in that ability to find the right acquirers, whether they're local or international, and get the right people to the table. Just the next Next key principle to cover is this idea of the right acquirer. So just maybe going into a bit more detail around that. And basically to get there, we ask three key questions. The first one is, in whose hands is your business more valuable than in your own hands? And yeah, you could also say, who can actually run this business better than I can? It's not about the individual. It's actually about the company. I mean, we sell almost zero businesses to individuals. In 99% of the cases, we're selling to companies. Now, in which company ownership would this business be more valuable? Where do we find access to more clients? Where do we find better ability to structure a business from a balance sheet perspective? Where do we find a better market, or a better market for someone else's products where our client base can bring value? Second one is, broadly speaking, who sells non-competing products to our client base? This is important, and one could have a whole separate seminar just on the idea of why we don't sell to competitors. And we generally withhold, if there are competitors we think are good, we're going to take our time before we approach them. Unfortunately, competitors are very good at stealing ideas from a company, even if they don't mean to. They're going to find something out that you don't want them to know. If they know that you're for sale, there's a good chance it gets to your customers that you're actually for sale, and that can be twisted into all sorts of wrong stories. And in the end, they don't pay. Competitors just don't pay. It always feels easier for them to try to take you out the market in other ways than to pay premium for your business. Not always. And generally, the place I would look at competitors is international competitors to a local company. Local competitors, be very, very careful. So often, funnily enough, it's exactly where people start. The first thing they do is think, well, who knows our business? Our competitors do. Let's go and talk to them about buying this business. Wrong place to start. And then the third one, which I think is one that we've developed more and more over time, is who's got an appetite for acquisitions. Funny enough, you can go and find businesses that feel like, wow, they answer the first two perfectly. They're right there. They're perfect in our game. But they're privately owned, and the shareholders are probably taking the cash out in dividends. They don't sit on a good pile of cash, and they don't really have a strategy for acquiring businesses. And so generally, one's got to look at ownership to find appetite. And a real acquisitive strategy doesn't generally come from operating shareholders. It comes from owners, and owners are the ones typically with the wealth and the balance sheet to acquire. So one's got to look for ownership, assess from the owners whether this is the right place. And this is why private equity is becoming a bigger and bigger place to do deals. So you find a business that looks like it's a good fit for you. You look at the owners, you find, wow, that's owned by an investment company, an investment holding company, private equity. Now, at least we know there's an acquisitive strategy there. And I'll go into a little bit of that later around the kind of who the buyers are and why we're finding there's not a lot of activity in the listed trade space in this country at the moment. A lot of it's being driven by the investment holding companies and private equity firms. Just going on to probably my favorite around all of these points, certainly my favorite slide, which I'm about to show you. But I think the key thing is, how do we get people to pay the best that they're willing to pay? And we used to just simply call this sell the future, to convince them that in their hands this business is worth so much, therefore they're going to pay more. But it's much more complex than that. And a lot of it comes down to the process that we run. So once you've got a good business, so you've presented it well, you've know who you want to approach. How do you get it in the market, and how do you get the people who are interested to put their best foot forward? You run it through a process. So the first thing we call this is deal heat. How do we create? You see this why I love the slide. How do we create an environment where we're going to get the best out of people, out of acquirers? We call it deal heat. It's just that little bit of tension which gets people to, yes, geez, we really want this, and we're going to have to act now. We can't act later. But just to unwind that a little bit, we start our process by firstly sharing some information, the information memorandum. In fact, before that, we get an NDA signed, so no one knows who the company is that's for sale. NDA, get an information memorandum, and then work at getting the parties who get that, to get them to meetings. And the key thing about a meeting, which again, it's basically sales 101, but when people sell businesses, they think it's a financial exercise. They don't realize it is a sales and marketing exercise. So when you think sales 101, when you meet a buyer for your product or a potential buyer, What do? You ask them first to tell you what their needs are. What are they about? And a very key part of those meetings we have is getting the acquirers to talk first, the acquirers to explain why they're there, the acquirers to explain why this business would be a good fit in their business. We learn so much from that. The key thing we learn from that is if it is valuable to them, we know when they do make an offer further down the line, we know how much headroom might be in that offer based on the value of your business in their hands. Very, very critical process from this deal heat perspective as well. So it's all about maximizing value by getting your best offer possible. We negotiate every single offer we receive. We don't always negotiate the price. We're always negotiating something, but we don't necessarily negotiate the price. If the price is good, that's great. Now you've got an opportunity to change the terms to meet your needs. That's often what we'll end up doing rather than simply chasing the number. And you find if you can accept a number, you've got a lot of opportunities to negotiate around the deal. Just going to the last point in the list. And this, I suppose, mostly plays, it is about looking outside the obvious. We often do sell businesses to people we didn't expect to, in fact, very often. But that said, the other thing is to look overseas. We certainly did our biggest deal ever last year. It was an electrical wholesale business. And we sold it to a French private equity firm, in fact. And, private equity's got quite a bad name among some people, the old-fashioned type of private equity. But in this case, literally came in, they acquired 78% of the business, invested in it, just basically took away all of the problems. This was a family-owned business. They cleared out the problems of the family ownership and structure. They had a big checkbook and were able to support the business in every single way. And that business grew by 50% in 1 year. Literally took, and off a big base, not off a small base, off a big base. As I said, it was the biggest deal we've done so far. Unfortunately, I can't share the details here, but hopefully I can share more with you if you're open to discussion after this. And just tell you how that deal went, what happened, and how that acquirer was able to add so much value to the business that they could grow it by 50% in 1 year. International investors, a number of great advantages to international investors. Obviously, a few intricacies one's got to manage, but generally we will always try to include international investors on our prospect lists and try to reach as many as we can. And it's not easy. It's not a given that you're going to get international interest, but we're working on it, and we really believe that there's opportunity to find, particularly in the manufacturing space, international players who want a manufacturing base which isn't in China or India. Likewise in the BPO space, and wanting operations which aren't typically India is a great BPO area, call centers. I think South Africa's got a great growing industry in that type of sector. But almost every sector there's room for international acquirers. One's just got to deal with a whole lot of localization issues as well, and just manage all the moving parts. In this world of selling businesses, there are a lot of moving parts. You've got to manage them all, and but just choose how you want to manage them, where you want to manage them, and what you want to achieve from those. So those are the key principles. I'm just going to go through a couple of other things to kind of help with the context of how we approach the market and what we do. But this one is the one I alluded to earlier, and that is that what we're finding is that the listed kind of bigger enterprises are not the best acquirers at the moment. They're not flexible. They're struggling to adapt to rapidly changing economic times. They're quite conservative, and they're very exposed to their shareholders and having to be very public about everything, which makes this sort of medium to large SMEs. I'm typically talking from 100 million turnover to maybe $1 billion or $2 billion turnover. Much more nimble, much more opportunist. And those are the guys, those are often they're either in the market to find investors, or they're looking for businesses to acquire. Particularly if you can find those medium to large SMEs with investment holding company or private equity backing. That's where you find real aggressive acquisition strategies. And those are the guys you want to get in front of. Smaller SMEs, I think, are subscale and feeling the pinch. Those are the guys who need the investment. They need the growth plans, and they need the investment partners. And that's certainly where one should be looking. Just a little bit more on kind of how we work. I think it just helps for people to understand a bit more about what we do. We basically, our engagement with our clients is in kind of three portions. The first one we call a BMA. Again, I could talk for hours on this. It's called a business evaluation and market assessment. It takes 2 to 3 months, and it's really a consulting exercise to assess the saleability of a business. We don't want to come to you and say, we're going to go and sell your business. We want to come to you and say, let's assess the saleability, and then we can sit around the table together and decide when's the right time to do this. 2 interesting examples. One is a clothing distribution business, workwear type of clothing distribution. We did that exercise. We looked at the value, and they realized actually they weren't going to get sufficient value for their stock. They were overstocked. They needed to reorganize the business so that they could get true value for the business separately and the stock at a different time. And so they've chosen to take a year away. They can take a year, restructure the business, and should be back with us towards the end of this year. Another one was a explosives transport business, went through their BMA process, got to the basics, liked what they saw, but just in the discussions realized that there were too many complexities in the shareholding that needed to be tidied up before they could go through that process. Again, taking a year off, we'll engage with them later this year, and it'll be a better deal for everyone. So we're quite happy to wait. We don't want to push people to make a decision about selling their business if they're not ready. If something's not right, let's rather wait and let's get the timing right. But it helps us and a seller of business to have given us that opportunity to engage properly so that we can kind of get a seat at the table in determining the next step. And the next one is this market engagement I talked about when I was talking about deal heat earlier, that process of engaging the market with a final list. We obviously need to finalize the list, finalize the information memorandum, and engage the market and assess the interest in the market. And then obviously from there, we're getting offers. Remember, we didn't put a price on it. We got offers. We negotiated those offers. And now we need to go through a deal making and conclusion process. And this is the part where one always struggles to control the timeline. There are lots of tactics one needs to put in place. We need to be very focused on exclusivity periods. We need to project manage that process very tightly with lawyers, sellers, buyers, all the different parties at the table. Tax, critical part of this process, and get all of that right. Unfortunately, it can be long. We obviously try to keep it as tight as we can to make sure that goes well. The other big trick here, which a lot of acquirers try to change, is you should never do multiple due diligences, and you should never allow a buyer to do a due diligence if you haven't agreed terms. So we will always make sure terms are agreed before we go into a due diligence process with an acquirer. So ideally, you're doing one due diligence with a final acquirer, and all you're doing is getting to conclusion. You're not renegotiating through this whole long process of DD. It's a disaster. It's a real disaster. If that starts happening, you almost know that something's going to go wrong. Now, there's a terrible saying, very popular in our industry. When a deal is 99% complete, it's got a 50% chance of failure. So you've got to be on your toes and watch all of the moving parts to make sure that you're able to get that thing to conclude, that deal to conclude. Nearly done. I just wanted to go through just some examples to give you an idea. If you are sort of new to us, you may not, you may feel a bit more comfortable seeing the type of deals we've taken on. And this is 10 out of the last, I think 14 in the last 12 months. And just giving you a sense, contract packaging business doing about 40 million EBITDA, and a Bry accessories manufacturer distributor, 35, debt collecting business, group of tire fitment centers, underground mining equipment that does about 100 million EBITDA, technology distributor, very much that tech distributor, really looking for a sort of 40, maximum 50% partner to help them with growth. You can imagine in that type of industry, you've got a big balance sheet, you've got a lot of stock, and the more cash you've got, the more successfully you can grow. So they're certainly looking for that, both strategic as well as financial investor. But smaller thermal insulation business, electronics manufacturer doing about 60. A very interesting business in the virtual monitoring game. Could talk a lot more about that too. And then a foundry doing about 30 million. And yeah, maybe the ones that I haven't mentioned, we do have 2 quite small clients that we do sometimes land up experimenting in certain sectors, and we're quite open with our clients. So yes, we can try, we're going to do it differently, we're going to do something different, but we unfortunately just don't have the capacity to take on many of those. And we've got to have a real belief that this business is saleable. Otherwise, we simply won't take it on. We don't want to sell hot air. We don't want to sell a promise that we can't deliver on. I believe pretty much all of these businesses will sell. We don't accept failure, and we certainly don't want to take on businesses that we think we're taking a chance on. We want to be able to look someone in the eye and say, this is what we're going to do, and this is why we believe it's going to work. And then, of course, the other two businesses are not in this list are the two which I mentioned, which have chosen not to sell at this point, and to sell to go back to market in the next 6 months or so. I really hope that has been useful. It's been a pleasure to have you as an audience. I really appreciate your time. And if you need to talk to us about anything, please pick up the phone, drop me an email, and we're very open to discussion. We need to learn more about your business. We accept that you need to learn more about ours and understand what we're about. But we do this with integrity. We do it because we believe in what we do, and we believe we've learned enough over the years to do it properly. And we're not taking chances. We're certainly not going to take a chance with anyone's business. We're going to do it properly. We're going to bring together all of the experience of our team, and particularly Andrew and myself, and make sure that experience works on every single project, rather than as some theory and you run a process and you hope for the best. And there's so many points in a project in the process of selling a business that need detailed understanding and experience to get it right. And it's our job to make sure all of that comes to the fore. I really hope you've enjoyed this. And please feel free to give us a call when you're ready.